All right, what's up, everybody? Uh, Last week's town hall was pretty interesting. Had a few people like Pinto, etc., that came up to the stage and shared ideas that they had on the design and marketing front. And feel like, to the extent people have ideas, proposals they want to share, suggestions, I feel like this is a good forum to do so. So maybe we'll just hold the floor for a minute or so, see if anyone has anything they want to surface. Otherwise, I may kick it over to Ben.
I think one
Maybe
thing
I'll-
interested in is whitelisting more assets. I remember reading some message about SUSD and maybe MakerDAO. I think these are interesting things to consider. Yield-bearing assets instead of USDC in the title.
Yeah, that's definitely interesting. At some level, yield coming from uh, these other stable coins is a great source of yield for Pinto, insofar as, there's obviously risk with each of these coins where they get their value from. But in general, the collateralized models are great in the sense that they provide yield and they're stable. Obviously come with either scalability issues or centralization issues, but given that Pinto already has exposure to USDC, it doesn't seem like that's a reason not to take on some of those yield bearing assets in terms of liquidity exposure. Obviously, it's different trusting Circle, which is about to go public, versus trusting other lesser known or less reputable or less ethical projects, if you will. So not exactly apples to apples, but pretty close.
Yeah, and I think it doesn't also mean we completely replace USDC. It could be that we split the current gauge that's given to USDC amongst like two other maybe like stable coins. Introduces risk for sure, but it's still like, kind of contained.
Yeah, I think it's definitely worth considering. It's not going to turn into that much yield is the reality, because it'll be such a small percent of the liquidity, which is already currently a small percent of the supply, and these assets don't yield that much. But nice to have something. What else? What's on people's minds?
Well, I've been thinking about the difference between the market that Beanstalk launched into and the market that Pinto launched into, with respect to, you know, I mean, I guess to the extent to which money was flying then and money isn't flying now. Felt like, in 2021, it was a little bit crazy town in the sense that, people would send each other links of new DeFi apps and, click buttons right away and ask questions later. And I'm wondering, the obvious, like, long-term view is that, well, at least at the moment anyway, Pintos and Beanstalk are mostly or entirely speculation based. And I would be curious to hear you pontificate on the path between here and there. There being, the state of quote unquote real economic activity and what pieces are required.
Well, this is the sort of classic dilemma, which is if the protocol grows tremendously exclusively as a function of speculative demand or inorganic demand that is just farming yield with no anticipation or intention of using the currency, ultimately that demand will eventually leave and likely significantly damage the health of the protocol. So, in some sense, growing without real use is a very dangerous game. At the same time, crypto has not really found any real world adoption other than for payments, and which you could say isn't even DeFi, and speculative trading effectively. So there's an open question as to whether or not there can be real economic activity using Pinto anytime soon. And at this point, I think the answer is things are very close. Almost all of the ingredients necessary are in place. And that is to say that the protocol is operational, it's doing its thing, it's building a track record. And Pinto was just deployed recently, in addition to hooking up Pinto to Cream and to Spectra, which allow for leverage and then speculating on interest, respectively. The only missing piece at this point, and it's worth saying, like with the Cream integration, there's a lot of danger that comes from the ability to just lever up the system to farm yield, as we said before. Like now that's more of a reality. And with Spectra, not exactly the same dynamic, but a similar dynamic where people can now lever up on just the speculative yield from the protocol, again, without real economic activity. And this is part of the nature of permissionless development. This is just how it goes. There's it's very hard to prevent, once the stablecoin is deployed, these pieces to be attached. So the big open question is, where is the demand going to come from? And how can the system be set up for demand in a way that is sustainable? And at this point, the provisioning of liquidity for various on-chain markets seems to be far and away the best use case for stablecoins, or in this case, low volatility money. And if anything, the open question is, can Pinto achieve a certain sufficiently low level of volatility and a sufficiently high interest rate such that the interest received compensates holders for the volatility they're experiencing? And this is a big and, while this dynamic is happening, the Pinto is used as a media of exchange, or a medium of exchange, excuse me, and as an asset that can be used to settle per markets, for example. And so this becomes the next step of integrations with the system. There is now this Pinto primitive, if you will, that is an ERC20 token that has yield and has volatility. And it is a fungible representation of Pinto's low volatility money. And it's potentially a very powerful thing. So in some sense, the question was, how close are we to being able to support real economic activity? How far is the gap? It's like, well, we need a market to start to use Pinto. I guess you could say, well, isn't that Basin? And in some sense, sure, there would have to be a real active campaign to have like tokens listed to trade against Pinto. And then there's an open question like, does Pinto really want that exposure where Pinto loses value when those assets lose value? So at this current size, like a very dangerous game to play. And so having Pinto trade against like long tail assets at this point and paying out yield to those long tail assets doesn't really feel like the best. Now, of course, in a permissionless environment, there's nothing that can prevent like an Pinto yada yada pair, which would earn the yield on the Pinto, but obviously wouldn't be depositable on the silo to earn additional yield. That's possible. But where I think things are more interesting isn't having Pinto be the settlement asset for a perp protocol. I think that has the potential to be real economic activity where the funding rates on the BTC Pinto perp or BTC S Pinto perp will be so much better than on both sides of the market than another perp. So you are now accepting additional volatility, not just the BTC exposure, but also the Pinto exposure. But from that perspective, you're kind of getting the best of both worlds. Now you could take it even further and do like a BTC USD perp denominated in S Pinto, or then maybe you get the best of all properties, but haven't thought that through, to be honest. But that's sort of that's what's been on my mind about this topic. So open question as to which is going to be the first per protocol to test this thesis out, but very exciting when it happens.
CB asked, Ben mentions a lot about Pinto data. What data are you happy with? Excuse me. What data are you happiest with currently, and what data would you like to see improvements to?
Very interesting. Well, I'll talk about the improvements. I can't say that the level of the temperature has been increasing pretty continuously. We haven't found a temp where there seems to be sustainable demand. I can't say that the quality of that data feels so great. Unclear if the way the temperature is adjusting is most efficiently finding the optimal temp. And so that's a piece of data that I think is not the most high fidelity. On the other hand, and this is directly related to it, however, the soil mechanism change, whereby now there's significantly less soil, is tremendous data. From where I sit, this experiment has made clear that the protocol needs more soil than 200 a season. Like the game theory there hasn't been great from my perspective. We haven't seen the soil ramp up sufficiently. And I think this has to do a lot with the friction of being at your computer to do this stuff, since we still don't have Tractor. But even with Tractor, you could say the data's still not great without Tractor. But I feel like already just to see that without automated action, while there's still friction, that people have to be at their computer, and there's so little soil at the beginning, no one is, or not no one, but much fewer people are participating in the field, has been really interesting data. And in particular, I'm looking at the Pinto supply. We talked a little bit about this last week, but the rate at which the supply has been decreasing has basically flattened tremendously since this change went into place. And at this point, it's quite clear to me that we need a lot more soil. I was talking to someone who has been a participant in Beanstalk and a participant in Pinto recently, and they were like, people used to just hop in and sow 50K randomly. That's impossible now. And from their perspective, it seemed like that really diminished the efficacy of the field, where it's like, yeah, how is the supply ever going to go down if people can't just do that at some temperature? And I think that's totally right. So there's an interesting, more data to get in terms of, will Tractor help with this? That's data I'm very interested in collecting as well. But at this point, to just see how the system works when there's high levels of friction to sow significant amounts, and how that's affected the ability of the protocol to decrease supply, I think has been tremendous data. So that's one coin that one side I can't say is great data, on the other side is really good data. And then I guess on the other side of that is more data that we would like to get in the future. But that's something that I've been thinking a lot about. I feel like it would be great to get historical, convert data by season and stuff. I don't know, Pinto Pirate, does that exist? I haven't seen that, I don't think.
Yeah, we do have some data like that. It's not displayed anywhere at the moment, but it's all tracking in the subgraphs for whenever there's like a liquidity add or remove, it's like tagging those as converts as well.
And what would be the load to sort of make that available graphically?
I mean, I guess it depends on how we would want to show it exactly. I mean, maybe one of the simple ways that comes to mind is if there's like a value we have for like the rolling 24-hour or the rolling 7-day volume. Maybe we could show something like that. I don't know.
I mean, there's a lot of different ways to display it. Like, I'd be interested in that metric. I'd be interested in the like season by season data or day by day data. There's a lot. I mean, there's so much there, if you know what I'm saying.
Totally. Yeah, and it's all there. It's just a question of how we want to display it. I don't think it's really clear at the moment, but I agree. It would be very good.
Yeah, well, I mean, what information do you need about that? Like, how can we make this happen?
I mean, nothing specific, I guess. I mean, maybe I don't know if now is the best time to discuss it, but I think just if we can come to some consensus of like how we want to present it, and then whoever wants to work on adding those charts to the UI, I'm happy to walk through the data.
Awesome. All right, cool. Yeah, I appreciate we're exploring what is the like right stuff to talk about in this forum. So I feel like getting into the weeds of execution maybe not the best setting for this, but sounds like something we should be doing soon, which is exciting. I think that would be great data to get. So thank you, CB, for raising this question. I'm thinking if there's other data that's top of my mind that I'd really like to get that I don't have. The seasons page has some really wonderful data. So that's been a great resource and allows for a lot of just high level understanding of what's been happening. And you can see that in most seasons there's no soil, or no soil sown is what it is. No Pinto sown. So from that perspective, it's quite clear that since this change was made, it's been a general failure. Other data that is really interesting or that we would like to get more of. Well, one thing I've been tracking a lot is the total liquidity, and in particular, how it relates to the L2SR and the overall health of the system, where we've sort of seen a flattening out of the L2SR, or at least the curve over which the L2SR was changing, where over the past almost month now, since March 10th, the L2SR has only gone down about 10% relative to what it was before. So it was at 17% and change, and now it's at 15% and change. And it feels like that bleeding has slowed down to some extent. Now, the market continues to be shit, and the liquidity that is trading against Pinto continues to go down in value. But just to see that despite that, the outflows have generally stopped, and the protocol seems to be holding its ground, even if the price is chilling in the 70s. I think a lot of this is what low volatility money is about, where and it's not a stable coin, it's not perfectly flat, but it isn't crashing nearly as hard as most of these other assets. And I think that's a proof of concept in and of itself. This is Pinto's first cycle. And in a bear market like this, where all of the value it's trading against is down significantly, and the protocol inherits that downside volatility, the fact that it's doing so much better, from my perspective, speaks volumes. So I know there may be fear about the health of the protocol, that the temp keeps going up and the L2SR keeps coming down. But from where I sit, it's a very, very powerful proof of concept that the protocol is hanging tight, that the outflows have generally stopped, and that the volatility of the price is significantly better than the volatility of the other assets that would be considered cryptocurrencies. So that's some of the data I've been paying attention to as well. Something we spoke about recently, Austin, was the RAI model of a changing value target. And on the one hand, I think super interesting as an experiment in and of itself, where if the goal is really to create low volatility money and we don't have an index of value that we really like, I mean, I guess you still have to have a value index, which is a problem in and of itself. So I take that back. But if you're less hard set on a particular value target, where at least the decision was made for Pinto that the USD continue to be the dominant denomination for assets on chain, such that we didn't want to have a different denomination. We made the value target equal to a US dollar, or the best proxy that we could get to a US dollar. But the RAI model says there's no need to do that. The only thing that matters is low volatility, endogenous value. And even if you're going to use the dollar as your reference point, such that you're calculating a price relative to that other asset, that there's no need to have a fixed target, and the target oscillates. So that's a very interesting topic in and of itself. But from where I sit, it's much more likely that Pinto can find, at least in the short term, product market fit with a value target of the US dollar versus its own value target. But I think at the same time, it would really play into the low volatility money meme much stronger. It's like, well, is this its own money, or is it some other, is it supposed to be worth some other money? So I think from the meme of this is its own money, it's very interesting. But in the short term, I still feel good about testing out the model with a hard value target. But I'm very interested in testing it out with some sort of like soft value target like this. I guess not soft. We should reserve that word for something else. But like a volatile value target. What else is on people's minds?
I skimmed through the filing for Circle, and I think one of the things that were highlighted was that a big percentage of their earnings is basically spent on, what you could call marketing, or what we call in DeFi as bribes. So just like paying people to use USDC. Do you think that this is how the unfortunate reality of things are, and everyone eventually has to pay some sort of things like that to kickstart adoption?
It's a great question. This is something that I think we will only find out in practice. With Beanstalk, there was no need for that whatsoever, except for the endogenous yield that is a part of the protocol. And I think that's really strong evidence that in the right circumstances, that's not necessary. I would go further and say with Pinto, if Pinto is to find product market fit, for example, as a settlement asset for perps, for example, that just the endogenous yield from the currency itself is enough to generate a flywheel or a network effect that generates real economic activity and a positive feedback loop. That's really powerful. So in my mind, my hope is that that's not the case, that the protocol doesn't need to pay explicit bribes. I would say that I don't classify the endogenous yield from the protocol that is distributed according to its normal mechanism as a bribe. I feel like that's the point of the protocol. That's it's doing its thing. So I would bifurcate like just some sort of mercenary yield from this. So from that perspective, I don't know, but I'm very interested in exploring whether or not it's necessary. And the only way to really explore that, because obviously once it starts to do its thing and grow significantly, you sort of lose the ability to collect that data. The starting point has to be a patient one of seeing, is it possible to start the flywheel without this? Once you start it, then if you bribe your way into it, then you lose the ability to validate the other side of it.
I don't know. I think from a yield farmer's perspective, the emissions of new Pinto being minted is very similar to what they would look at if they were just providing liquidity on Curve or Convex, or locking in a certain rate on Pendle or something. I know that the protocol might not look at it that way, but I think the community looks at it as, what's your APY and what's the risk, and therefore they determine how much to put into it. But I know that we're a little bit different.
Well, I think that's exactly the thing. Like, I would classify that as mercenary capital, that is just going around yield farming for yield independent of the source of that yield. And if the source of Pinto's yield is demand for this yield that has no source, eventually that house of cards is bound to unwind. So from where I sit, the way out of this is to find a place where Pinto actually has utility. And I've proposed today that the lowest hanging fruit and realistic way that could happen is through being used as a settlement asset in a perps protocol.
You like that more than the CDP idea?
Well, I do like it significantly more, because I would argue that taking the Pinto and wrapping it in a CDP to mint some other, call it stable coin against it, is basically just the system taking on leverage.
No, I mean the idea that you can take, for example, your Bitcoin and then mint Pinto against that. Under circumstances, maybe the system would only want
Pinto
to allow
becomes
you to.
collateralized?
Yeah, partially. Yeah.
No, that idea I can't stand.
Why is that?
Because
it's
that compromise.
It's collateralized by credit right now already.
No. Come on. Credit and collateral are very different things. Collateral is collateral. Collateral has a definition.
Yeah, sure. Yeah. But if you had to describe like what is backing something, I would describe as credit backing Pinto. Is that Would you describe it differently?
Exactly right. But so therefore, I would say that the replacement or the partial replacement of that credit backing with collateral backing totally damages the value proposition of the system, and in particular threatens the trust that people will place in the credit of the system. Like, are you backed by credit or are you backed by collateral? This was, I think, one of the big, just from a power projection perspective, this is one of the big mistakes that Do Kwon made that led to Terra unwinding, which was the purchasing of this Bitcoin collateral reserve, which ultimately totally compromised people's faith in the model and led people to question, well, what would happen if all the Bitcoin ran out? And that is a very ugly situation once that unwinds. And we saw what happened. So I am very strong against any sort of collateral for Pinto.
I feel like that's a slightly different tune than what when we got together a few weeks ago. One of the ideas is that we can, Pinto can be used and be created at a lower carrying cost than like all of the other CDPs on the market, and so that's like
I think we're mixing things. We're mixing things. I think this is the idea that within the liquidity pool or the value that's in the silo, that Pinto can basically the value in the silo can be lent out, or Pinto itself can be lent out, if you will. So as I understood that idea, it was that the protocol has all this Pinto in the silo, which is doing nothing. And insofar as the protocol wants to collect some sort of yield on that Pinto, it could lend it out, for example, right? So that's a very different thing. Using Pinto as collateral, using Pinto as the asset that you're borrowing against some other collateral is quite different than, and I guess the difference is Pinto owns the Pinto. It's already someone took the LP tokens or the Pinto and deposited it in the silo. Pinto now can lend out that Pinto because in the worst case where there's a need to fill some demand for Pinto, there's a run on the silo to fill that Pinto. Pinto obviously could always mint more Pinto. So what you'd expect to happen is the price would go up and the protocol would mint more Pinto or something like that. This idea was a little far out there, so we hadn't gone through all these details. So it's still a little foggy for me on how all that would work, but that's very different than using, like Bitcoin to mint Pinto as collateral based on the Bitcoin collateral.
Yes. Yeah, you're right. I absolutely agree that that's a much better. It's both a way of using the existing Pinto that you could argue is only, just sitting in the silo and could be used more productively, and also ensuring that the whole system is backed entirely by credit as well. So, yeah, cool. And I also find it interesting that you mentioned, like, if people borrowed too much of this Pinto and then somehow there was a large amount of withdrawals such that not everyone could, if they wanted to, like if you hit the point where the next guy wants to withdraw and there's no Pinto in the silo, then the system would mint that Pinto so that he could withdraw it.
That's right. It's hard to know exactly how that should work in the sense of, like, the protocol. I think it's a very interesting situation to think through, because the protocol. Go ahead.
No, I was saying what you typically do in this case is jack up the interest rate that will make the borrowers close their loan. If they don't close their loan, they pay an interest.
Totally, but that's not a solution that's instant, that's over time. So I think there's still a very interesting question as to what do you do if, let's say the only, just as a basic example, no LP tokens, only Pinto that's deposited in the silo can be lent out, and there's some like maximum ratio of 50% of the Pinto in the silo can be lent out. Now it's at the maximum, and the depositors of Pinto in the silo start to withdraw their Pinto. The protocol now is over its 50%, which means that no one can borrow any more Pinto until it goes back down below 50%. But the withdrawals keep coming, and now more than half of the Pinto that was in the silo at the time that the 50% cap was hit have been withdrawn. Now the protocol is going to run out of Pinto. It will have lent out half, and now half have been withdrawn, and now there's basically another 50% Pinto that could be withdrawn. As soon as people start to withdraw, it's like, well, what does the protocol do? And so on the one hand, it could just mint. I think what would have to happen is the protocol would have to mint enough Pinto to bring basically to fulfill the withdrawal. But then there's an open question of, like, who gets credited that Pinto. So in some sense, I think the way it would have to work is that users would have to have like a setting where they could say any Pinto that's minted to me can be lent out, and then the protocol would have to mint like enough Pinto such that it was able to lend out enough to remain solvent. But that seems kind of like fakaked and backwards. So I feel like there has to be a better way to do it, because it seems like it would probably mint maybe too much in that instance.
I mean, from my understanding, I thought the deposits would opt in. Like, each depositor would need to opt in to allow their deposits to be lent in return for a similar interest rate, and the possibility of them not being able to withdraw if the amount was lent out too much.
So it's like they would just be foregoing the right to withdraw.
Yeah, I mean, right,
then
like with the model you
This
described,
is like
it
now
feels like
there's a
it's all
run on the
shared.
bank, which is like in some sense, this goes back to like the fundamental. This is a longer discussion about what do lending systems look like on this structure? Like, how much does it resemble the banking system? How can you basically guarantee solvency of the loans? And then in the instance where the loans default, whatever that means in a blockchain context, which is like I said, a much larger question. But in the instance where the loans default, who basically loses? Does the protocol repay depositors? Are the Pinto lost? Whatever that means. very, very interesting, like macroeconomic question that has to do with creating an entire economy on this currency that is more fair than the status quo. So I feel like that's a whole can of worms, how to actually do this.
Like a can of worms you don't want to open right now.
It's like I feel like it's like an hour-long discussion if we're going to do that. And honestly, one I haven't prepared for. It's quite deep. I can't say I feel good about leading that discussion.
You like this blending the silos Pinto model more than perps?
No, I feel like lending I mean, it's not about like liking it more. It's like just what's realistic in the short term. I think perps realistic in the short term. You just need a protocol to do it. I think this like a lending system is a much more sophisticated thing. Where in the short term, sure, we could have the Pinto lent out to just be used to trade stuff. But if we're talking about building out something larger than that, it's a much more complicated question. I think in terms of just perps versus the short term lending out the Pinto to collect some yield, I think that's very interesting. But at the end of the day, the most likely use case right now for this is to speculate on other assets, which I mean, it's not so bad. It just means that the flow is going to be like people borrow the Pinto and sell the Pinto to buy other assets, and therefore it will create short-term sell pressure, but then long-term like continuous demand in the form of the yield that's being paid on the system. So that's an interesting one, but I think it's like people are paying the system yield at the cost of short-term sell pressure. Very interesting, totally different trade-off space than utility through perps. Like they're totally different. The perps, people are holding the thing to do something else with it, and the holding of the Pinto or the S Pinto means that there's continuous demand for the currency. Whereas, and that's like demand for just holding the currency and doing something with it. Whereas the lending is still some sort of speculative use case, which generates income for the protocol over time in the form of interest that people are paying, which is sort of like the promise of future demand for Pinto in exchange for short-term sell pressure. So I think they're highly complementary. It would be great to have both, but I think getting a perps protocol to use Pinto is probably easier than building out this whole lending system. But the way we work, I feel like it would definitely make sense to try to figure out how to develop this lending system.
Oh, so you're suggesting not that Pinto spends its resources developing a perp system, but just integrates with an existing one?
Yeah, I think that's like, whereas the lending of the Pinto from the silo is a Pinto native thing that would require Pinto specific work. Getting S Pinto used in a perp protocol is much like there's composability of ERC20 tokens. There's no need to build a Pinto perp protocol.
Yeah. So how do you see that playing out? Like you go knock on Hyperliquid's door or whatever the other perps protocols are and say, hey, do you want to use S Pinto? And then they're like, I don't know, what's the benefit? And how do you see that playing out?
Time will tell. Only one way to find out, though.
Cool. Hope it works out.
I mean, yeah, for me, the lending in the silo seems feasible, with the perps. It's just hard to see any protocol in the EVM that develops a perp protocol compare with Hyperliquid or other perp systems out there.
That's a great point for you. EVM native perps are not competitive. I love this discussion, though. It's so, like, the picture becomes clearer and clearer the more we talk about it. Like, what does a Pinto economy actually look like in the short term, in the long term? I think this is a great discussion.
One of the things I like about the idea of lenting out the existing Pinto in the silo is if you limit it so that you can only, borrow Pinto if it's pretty close to peg, then as soon as it depegs, there's a lot of incentive for people to repay their loans, which is a pretty powerful form of, peg maintenance. And I feel like often on the upside of during Pinto growth cycles, there's so much growth, and it's like if you could borrow Pinto on the way up, that's kind of another way of cooling off the growth cycle and increasing the chance that it's more of like a longer run sustained cycle as opposed to like a really quick increase in market cap. And then as soon as there is, the first sign of a DPEG or a going below target, then people will want to close their loans immediately, which will bring the system back to target really fast, which kind of might increase like people believing in the system that it can work, and then therefore continue a steady growth cycle. So maybe I'm just hypothesizing too positively, but I could see something like that potentially playing out.
I think the latter part, oh, go ahead.
Why are they paying back their loans immediately the moment they cross this value target afford?
I think the suggestion is you could just build that into the system, or like the interest rate spikes when the system depegs.
Yeah, but also like if all of a sudden now Pinto is 95 cents instead of $1 on however much money I've borrowed, that's a free 5% ROI. So I can immediately get that 5% return on investment by repaying off my loan. This is why CDP coins normally return back to peg very quickly as soon as there's even a minor depeg, because people take out large amounts of loans just waiting for a depeg, and then as soon as it does, then they pay the system back.
I mean, yeah, I think that happens like after the depeg, not during the depeg, right? Like SUSD just had a major depeg from $1 to 90, and then yeah, I think it's slowly going back up. So
I think synthetics works a little bit differently though, but I'm not familiar with all the details.
oh yeah, I'm not familiar either. I assume it was just CDP going it, but
I think the synthetic DPEG has to do with I don't know the details enough, but they created like a new pool that incentivized people to change some stuff. So the DPEG is not like a real DPEG. It's whatever they're doing. They have a 420 pool, I think, and they changed their collateralization ratio, so it's like a bit of like a movement happening there.
I think both ideas, both sides of this idea are very interesting. One is just this natural, you get a discount on the repayment of the loan, which is great. You lock in your return. That does sort of unwind the sell pressure that was received when the leverage was taken via the loan. And then separately, the idea that you can force that function by raising the interest rate is interesting, but that does potentially compromise the utility of Pinto or S Pinto as an asset that you're borrowing, because obviously the volatility of the interest rate isn't super attractive. In terms of making the growth cycle more sustainable, I think that's a very interesting idea where you can sort of imagine that as the demand comes in, some participants sell, some participants basically borrow the Pinto and sell it with the expectation that the price will return to its value target. And in that way, you can minimize the excess demand. And then I guess that demand comes back over time as the price returns to its value target. So very interesting how that would play out.
Yeah, it's like a better way of like S Pinto is not something you really want to short because it has such high potential to start printing. But if you could borrow just regular Pinto, and Pinto itself could determine, what the market rate is for borrowing against your ETH, your Bitcoin, whatever, and just kind of like undercut the market to make it more attractive. But then also, I think the system should limit that only if it's reasonably close to peg and if L2R is reasonably decent as well, because every borrowed Pinto presumably is going to be sold immediately, which is going to cut into L2SR. So you'd only want to do that if the system is reasonably healthy. But then if you capture that, that borrowed Pinto on the upside, as soon as there's downside and liquidity starts to leave the system, then the repaid Pinto brings liquidity back very effectively. So yeah, it's an interesting idea.
So all of this is to say, Austin, real economic activity is on the horizon. All right, we're closing in on the hour mark. Does anyone have any closing remarks? Great. Thank you, everyone, for coming. These discussions continue to be very inspiring and exciting, and I hope that as we continue to have this discussion, more people join the conversation. So appreciate the voices that have started to participate publicly in this discussion. Frio, Ford Pinto, Austin, Pinto Pirate. Thank you guys. CB, thank you for participating async. But the more people that feel comfortable asking questions and contributing to the discussion, I think the more productive we'll be here. So my hope is that as we continue to do this, the forum continues to open up. Thank you, everyone. We will, I think we have another discussion on sometime soon. I don't know exactly when. Austin, when's our next discussion?
Looks like there's a dev call tomorrow.
Great. All right, everyone.
Call
Talk
tomorrow,
soon.
and then I think Thursday we're going to talk about the convert bonus spec and other various implementations we have in PI9. So design focus call.
Great. I look forward to that one. I don't think I'll be able to make the dev call tomorrow, but I'll be there on Thursday. Cheers, everyone. Take care.
Thank you.
Cheers.
See ya.
Bye.